Okay, so in this session, we are going to continue with markets, and we are going to look at the Boston Consulting Group Matrix. Now, the Boston Consulting Group Matrix assesses the business in terms of its potential cash generation and cash expenditure requirements. Now, most of the time, you will be using the Boston Consulting Group matrix mostly for assessment of business portfolios. But the same way, you can use this to assess your markets, right? As in how you are performing on a particular market by looking at your business unit or products and how they are growing and what their market share is. That is why we are covering it on the markets. But there are other models which are similar to the Boston Consulting Group matrix that are used to also assess product portfolios, to develop portfolio strategies, or to assess your markets. And in this session, we are just going to look at the BCG matrix, and then subsequent sessions, we are going to look at how to use the other portfolio models, because the BCG matrix is the one that requires a little bit of calculation, but the other models are pure theory. You just need to identify maybe if it's the business unit strength or maybe it's your competitive position and match the two. So we have seen the Boston Consulting Group matrix as seen in the diagram here, and it breaks our product portfolios or businesses, divisions, strategic business units into two, okay, 2x2 matrix. So we have high, relative market share, and what? Market growth, high, low, relative market share, high, low. Now, we have products which have high market share and high market growth. These products are known as stars. And those that have low market share, but they have high market growth, they are called question marks or problem children. And the ones that have low market growth but have high market shares are called cash cows. And then those that have low market share and low market growth are mostly known as dogs. Now, from when we looked at the product life cycle, you remember that it went in this fashion. Also from, let's say, from introduction of the market to growth stage to maturity stage, then to decline, right? Now, looking at this, you can look at a company's relative market share or how a company's market share really takes up in the market from introduction of an industry or introduction of a product's life throughout to the decline stage. Okay, so if you are looking at the company performing using the product life cycle or talking about the industry, you realize that mostly in the earlier stages of a business, market share is very low and a product may have a potential for growth. So most of the time, these question marks, for now, we don't understand what they are, but just according to their relative market share and then their market growth, you can tell that mostly products here in the earlier stages will be problem children or problem child or question marks, right? Because it has potential for market growth. Market growth may be high. So mostly it's between the introduction and growth stage that you mostly have question marks. And this problem child or this question mark product, we can mostly see them between the intro to the growth stage, right? Now, the growth, they have high market growth, which is growth in revenues, but they can't capture a huge amount of market, right? The revenue peaks by larger percentages, but you can't take a bigger percentage of the market compared to your other competitors, if there are any. Okay, that's why we adopt problem child for the introduction stage. Now, as you grow, you realize that people are now aware of your business, and then you start making what? Good revenue, that's high market growth, and also you have high market share. In terms of your other competitors, your market share becomes huge. So the product there is a star, right? So a star has high market growth and high market share. But at the maturity stage, because a lot of competitors have set in, they reduce the amount of revenue or the profitability of the star. That's why a star is not a cash cow, right? A cash cow is in the maturity stage, and here, mostly in the maturity stage itself acts as a barrier of entry. And as a barrier of entry, people really find it difficult to enter because there's economies of scale, the existing rivalry is high, and at this stage, you've already reaped what you want to reap. So you have a lot of cash. Now the product is there, people are aware of it. Not so, though you may not have substantial growth in revenues, but your revenue will be sort of stable or constant. Okay, so market growth is considered to be low when it comes to the maturity stage. That is why products here are cash cows. Yes, they have a large chunk of the market, but the growth in revenue is so low. But at the decline stage, your revenues will decline and your market share will decline. So the product we have there is a dog. Okay, so if you know it like this, then you can sort of, when you are explaining, you can sort of chip in the product life cycle and know what strategies can sort of help the organization. Okay, so we saw what market share and market growth are, or relative market share and relative market share and market growth. Now, how do we work with them? Because you can get some calculations, and I'll take you through some few illustrations. Now, when it comes to market growth rate, is how we were calculating sales growth. Is the same thing. Okay, so calculating sales growth, we know that we take what? The new figure or the current year figure minus the previous year figure all over the previous year figure times 100. So you are just looking at the growth in revenue, okay? So once you do that, then you are able to get the growth rate. So this is the growth rate of the market sector. So they could give you cash flows, they could give you profitability, or they could give you revenues, okay? It depends on the information you have, but that is how you are going to calculate your growth rate. Now, one thing you must know is that sometimes the student can calculate it, but he doesn't know which growth rate is considered high and which is considered low. So when you are calculating market growth, when it is 10% and above, when it is 10% and above, it is high. Okay, so 10% going is considered high. Anything below 10% is considered low. So high growth rate industries offer a more favorable competitive environment and better long-term prospects than slow growth industries. So new markets usually experience high growth rate and mature markets may experience slow growth rate. Okay, so please remember this. We are going to take some illustrations right after. Please remember this. Now, when it comes to relative market share, it has to do with what percentage of the market are you capturing? And it's mostly the ratio of that strategic business unit, the current business you are dealing with, its sales to that of the largest rival in the market sector. So if you want to calculate this one, you can take your revenue of your current business unit all over the largest rival in the market, his revenue, and that gives you your market share. Now, the BCG suggests that the market share gives a company cost advantages from economies of scale and learning effects. Remember, I was telling you that most of the time, to get a greater share of the market, you must have some cost advantages or economies of scale. Sometimes access to distribution channels, customer loyalty, all these things are signs of having large market share. Now, how do we measure relative market share? How do we then measure our relative market share? Meaning that what relative market share is considered high and which one is considered low. This is something that I want my students to be aware of, because if BCG should come again, I want you guys to be very good at it. Okay, so a relative market share greater than 1, okay, if it's greater than 1, it indicates that what? It is high. It depends on the school of thought though. Some people assume 0.5 to be high, but I want you to stick to 1 because that's what the examiner mostly gives you. If not, look at the nature of the question. So the threshold for determining the relative market share is subjective. However, usually relative market share of 1, okay, when it is above 1 becomes like the midpoint. So anything above 1 is considered high. Anything below 1 is considered low. Okay, so when you are doing calculations, anything above 1, which is, if you are working in percentages, 100%. Anything below 1 or 100% is considered low. That's when you are working in percentages. Other school of thoughts consider the 0.5 as high. So this is relative market share and market growth. So when we are working a question, this is what I want you to look out for. It's not just about getting the product, but knowing the nature of the product and what it relates to. Okay, so know what star is, how does it perform, and the rest, right? But here, the focus is sort of on the calculation. So through the calculation, I would take you through what each product represents and how you are supposed to answer it in a question. Though what I'll give you is on a tutorial basis, not necessarily how you are supposed to do it, but just look at the key points. Now, the company I'll be taking, this will be an extract from November 2021, question 1. November 2021 was a company in the telecom industry in Ghana, and it is actually MTN, which was taken as the proxy. Okay, so let's just look at the company. It said Com is the market leader. So they've already told you that it is the market leader in Ghana's increasingly competitive mobile telecommunications industry, growing from a subscriber base of 8.7 million as at 31st December 2010 to over 24.4 million at December 2020. The company's sustained market leadership has been fostered by its efforts at introducing innovation to enhance the experience of its customers. Known to lead the way, Com was the first telecom operator to provide telecommunication coverage in all 10 regions of Ghana, launch 4G Lite services as a mobile operator, offer 4G Lite in all 10 traditional regions of Ghana, launch electronic recharge and fixed wireless access phone, FWAP, launch mobile credit transfer, set up a charitable foundation with a 1% profit after tax annual contribution to charitable projects, that is the Com Foundation, launch BlackBerry service, introduce 3G and 4G commercial service, launch mobile money service, introduce Blade cluster technology in Africa, and build 3 ultra-modern switch and data centers. So they gave us Com currently has over 87 centers, service centers and 186 volume management centers across the country. The company also has over 270,000 airtime retailers who trade with Com products, in addition to 89,748 Com mobile money agents and merchants as of December 2017. With an ultimate aim of customer satisfaction, Com operates an extensive network in Ghana, reaching all 10 traditional regional capitals, major cities, and many rural and remote areas, as well as roaming partnerships with international communications operators in foreign countries around the world. So Com continues to offer its valued customers a range of exciting products and services under postpaid and prepaid mobile subscriptions. So for what we even read, we saw a lot of strengths, but because my focus was not on strengths and weaknesses, opportunities and threats, I didn't mention any of them. But let's come into the industry. So he said there are a total of 4 mobile telecommunication operators in Ghana as at September 2021. So we have Com, Phonetel, Natel, and Gotel. Now, these ones tell you the competitors. And remember, when you are doing BCG, I told you that you need a rival. Okay, so the rival's revenue, the greatest rival's revenue, or the rival which has the largest revenue against yours, can give you your relative market share. That's why you have to dive into the industry. So I'm giving you tips so that you can deal with questions when calculation on BCG should ever pop up. So the current telecommunication operators have licenses covering 2G, 3G, 4G, which are expiring at different periods and would have to be renewed. The telecommunications industry in Europe, America, and Asia has commenced offering 5G services to mobile users. However, Ghana is yet to acquire the requisite telecom infrastructure to pave the way for 5G services to be provided by the 4 mobile operators. So even this statement tells us that other countries, I told you, most of the time when you start seeing other countries, start thinking about Porter's Diamond. Why? Because it tells us that Ghana's infrastructure here is at a disadvantage to support the international market for 5G services. And this will be what? Adverse factor condition. And because of this adverse factor condition, it might affect demand conditions in Ghana because, one, they are not offering 5G. I get, and citizens are not even well equipped with resources to even accept 5G because they do not have enough money. Okay, so these are some of the points you should be looking out for. So I told you, any case you get, start thinking of all the models and how they can be applied to the case. Very important. But that is not our focus today, but I hope it helps. So one significant benefit of the availability of telecommunications infrastructure in Ghana is the introduction of mobile money services. Com is the first telecom company to launch and pilot mobile money in Ghana in 2009. That's way back. Subsequently, all the other major telecom operators followed the trail blazed by Com. So Com sets the standard. He started. And presently, 3 of the 4 communication companies, Com, Fontel, Netel, offer mobile money services, which the Bank of Ghana regulates under the Electronic Money Guidelines and Agency Guidelines issued by the Central Bank in July 15, as well as Payment Systems and Services Act at 987. In addition, since 2019, 2 new mobile money services, ZPay Mobile Money and GCBG G Money, have been launched by ZPay, FinTech, and GCB. Now, anytime you see things which are similar to what you have in a case, then these could be alternative products, right? Anytime you see alternatives, start thinking 5 forces. Remember, 5 forces, threat of alternatives. Okay, so I'm just giving you tips. When you see some of these things, just write them down or annotate around them so that you can use it to better your explanation. So he said, it brings to 5 active mobile money services in Ghana. Mobile money represents significant advantages to unbanked populations as it reduces transaction costs of financial services, especially for people in rural areas. Furthermore, it has created many jobs and saves travel time and costs, otherwise required to access financial services in less developed parts of the country. The summarized industry information is given below. So they've given some information here. So we have seen the companies, we have seen their revenue, okay? There's the market data. So we've seen their revenues. These are all in Ghana cedis. Their revenues for each of the services that they offer. Okay, so these are the various services that they offer. So we'll come to this data. So they've given some information here. The penetration rate is a ratio of total subscribers per product or services divided by the estimated population of Ghana in a particular year. This is a measure of the average number of Ghanaians using a service, and this can help you do analysis. Maybe when you're talking about their financial side, you can even talk about the penetration rate as well. Now, the telecom industries has a number of subsectors that provide solutions rivaling the 4 mobile operators. These subsectors include mobile network, internet service providers, broadband wireless providers, value-added service providers. So these ones can also be considered subsectors of the original mobile money sector. Remember, fragmented industry. And the same way, we could have strategic groups. These are what other groups which are in subsectors and do not pose a big threat because they are smaller than you. So for instance, if you have KPMG, the big 4, KPMG, PwC, Ernst & Young, and Deloitte, and you have some small accounting firm in your locality, which may be class C, class D firms, small firms. So far as they're in the same, they also do accounting services. Doesn't mean that they can compete with the big 4, but they are also groups which together can have power, or you can analyze them as to the one that can give you the highest rates, the one that can give you the lowest rate, and so on and so forth. So that's what you do. We call it strategic group analysis. Though this one, it is in your syllabus, but I don't think there will be any giddy question like that. The reason is because the ICA tries to focus more on the board picture, okay, the board level. So you just need to know which entities or which services they are offering that could pose as strategic groups. I don't think they can go further than that. Now, question 1 says that the first quarter 2021 board meeting, the performance of the company was reviewed following a comprehensive presentation of the financial performance for the year ended 2020 by the CEO, Elikem Ubaji. Now, although the directors were generally satisfied with the performance of the company and the presentation, they expressed concern that the performance of the various services provided by the company was missing in the presentation. So they said you are an advisor to the board chairman, and he has directed you to write a report assessing and classifying the various services provided by the company using the BCG Matrix. The report should include recommendations of an appropriate strategy or action the board should pursue with respect to each of the services classified in the report. Your report should contain an appendix showing the detailed computations supporting your classification of the services. This is 20 marks. So what are we supposed to know? So per the information here, what we can do is sort of get what? The market growth and then the market share for all the services. So I'll just take one, then I take you through the solutions. Once you get the idea, and that is all that you need. So to calculate market growth, we can take any. So you are going to do for all the services. So for instance, if I take mobile voice, for mobile voice, when I need the growth, market growth rate, okay, so market growth rate, I know market growth rate is giving us what? My current year revenue, so 2020 revenue minus 2019 revenue, all over 2019 revenue times 100. Now, so this is what we learned. So the same way, I can just calculate it as what? The 23,144 minus 2019 22,556 all over 22,556 times 100, okay? We know this is how we calculate growth, sales growth. So 23,144 minus 22,556, all divided by 22,556, okay? So this is a growth rate of 2.6%. So 2.6%. And 2.6% is considered low, remember, because I told you that if growth is more than 10% before it's considered what? High. So for mobile money, we have done this for com, right? It's only for com. For growth, we are only concerned about com. Don't go and do for the other competitors. It's market share, relative market share, that we need the largest competitor in the market. So if I'm supposed, now that you've got these 2 points, is if I want market share, for instance, I know that my relative market share is giving us what? The revenue of what? Com from mobile voice over the revenue of the largest competitor. And when you look at their revenues for 2020, which was the largest competitor? So the largest competitor compared to all of them, I think, was PhoneTel, right? So that means is the revenue of com of the over the revenue of PhoneTel, because PhoneTel was the largest. So in that case, that means if you are calculating this would be 23,144, which is the current year, over that of PhoneTel, which was 8,401, right? And I told you market share, if it is more than 1, then you are doing well. That means you have high market what? High market share. So if we take the 23,144 and divide by 8,401 for PhoneTel, you end up with 2.75. And 2.75 means that you've covered more than one of the market. And also, you have a high market share. So this is considered high. So that means if we are looking at mobile voice as at 2020, the mobile voice has what? High market share. High market share, and then it has what? Low market growth. So any product with high market share and low market growth, we know that is a cash cow, meaning that a lot of people pursue, or a lot of people go for mobile voice. And it is true. When you look at the telecom system, everybody talks on the phone. So it is a cash cow for them. Okay, though the market growth is low, it is a cash cow for them. So this is how you go about it, and you do for all of them. This can take some time. So without wasting much time, now that you've understood that process, we are going to go through the solution together. So based on this, you see, if you are doing relative market share, you take MTN, which is com, not so. Then you take the nearest competitor, then you divide. So we divided this, we had 2.75, classification high. Then we have this one. So that's the understanding based on what I did. So you do for all the products. So mobile voice was considered high in terms of market share. We come to market growth. It was considered low. Which figure is this? Oh, which one was I using? Was it mobile voice? Oh, sorry. The total sector revenues. The total sector revenue should have been used. The total sector was given. So we should have used the total sector revenues for the market growth rate. So if total sector revenues are given, you use that. So the 4462 and 4867 should have been used. So instead of getting the one that I did, because total sector, most questions, they don't give the total sector revenues. So in that case, we would have taken the 4462 minus our 4857 all divided by 4857, okay? Because sector revenues was given. So that's what we should have used. It's good that I had this reminder, 462 minus 4857. So this one divided by 4857, that gives us negative 0.096%, okay? Which is so low. But we still had it as low anyway. So it will still give you the same answer, but once sector revenues have been given, it's better to use that one. So this is how you go about the calculation, okay? So after you do, it's not necessary to do this table. You can arrange it in a vertical form. So we see mobile voice becomes a cash cow. So cash cow, there are some strategies that you need to know. So mostly cash cow, you hold it. Holding means that you keep it, right? You maintain it as it is. So you can call it hold or maintain. Then we have fixed line. It seems fixed line had low market growth and low market share. So it will be classified as a dog. And for a dog, most of the time, it's not always the case. So when you are arguing, you need to know. But for a dog, most of the time you have to divest, meaning sell the dog. Okay, a dog that is not back and you need to sell the dog. So you divest. So fixed line, nowadays people are not using landline. So you could choose to divest. As I was saying, you have to look at each product. So a dog, you have to sell it. We have mobile data, which was also a cash cow you hold. We have fixed data. It was a question mark. You build or harvest. So building means that you invest more into that product or that service. Okay, then we have mobile money, which was also a star. So you build, you invest more into it by taking either money from the cash cow and putting into the mobile money. Okay, that's what you do. So that's how you go about it. So you see, this is the calculation for market share. This is the calculation for market growth. And then let's look at the examiner's comment. What did the examiner say about this question? What was the performance of students? He said, it was the application of the BCG, and the requirement included an assessment and classification of the various services provided by Com Group and an appendix showing details of computation. This was a popular question. Most of the candidates were able to classify the services correctly as star, cash cow, question mark, and dog. They were able to recommend appropriate strategies for each of the products or service. However, some were not able to support their answers with relevant computation. So this is mostly the problem that we have when it comes to BCG. Students are able to explain what star is, what question marks with the strategies, but they can't do the calculations, which was what I said when we started. So what are the strategies under the BCG matrix? So we first have build or invest, as I told you. So a build strategy forgoes the short-term earnings and profits in order to increase market share. So this could either be done through organic growth or through external growth. That's acquisition, strategic alliances. So you see each thing, they all work together to achieve this. So if you want to invest in something, you can do it with your own resources or you can do it with somebody. Then we have the hold strategy, which is like maintaining the product or service or the strategic business unit. And a hold strategy seeks to maintain the strategic position, hold your current position. So defending it from a threat of would-be attackers and when necessary, not doing anything. So as and when necessary, it makes complete sense. Okay, so harvest means seeking short-term earnings and profits at the expense of long-term development. So let's say if a cash cow makes money, I can harvest from there and use it to build other products. So we call it robbing Peter to pay Paul, right? That's what we call as harvest. Divest means dispose poorly performing business units or products or services. And also you dispose them off. And divestment stems the flow of cash to a poorly performing area of the business and releases resources for use elsewhere. Now, the various products include what? Stars. So these are products with high market share and high market growth. And they are more prevalent in the growth stage in the industrial life product life cycle, as I told you earlier. So in the short term, these require capital expenditure in excess of the cash they generate. So in order to maintain their market position and to defend their position against competitors' attack strategies, but they promise high returns in the future. Okay. So you remember I was telling you that these are mostly for the growth stage. It gets a lot of money, but because competitors are coming in, they reduce that revenue. So what you need to do is to build it. And how do you build a star? You invest in it. You get it. You don't have it. Sometimes a star may be performing well, but we mostly try to build it to become a cash cow. Now, for a cash cow, we know that these are products with high market share and low market growth. Cash cows are most likely to be found in the maturity stage of the product life cycle, and in due course, stars will become cash cows. But to make them cash cows quickly, you have to invest in them. Okay, so cash cows mostly need very little capital expenditure because opportunities for growth are low and generate high levels of cash income. However, products which appear to be mature can be reinvigorated, possibly by competitors who could come to dominate the market. So they can rebrand your product or bring one which looks superior than yours, though you have the market share already. You could see this in the IT industry. There are some, look at the way people were using for instance, Photoshop, and all of a sudden they've brought AI models. So all of a sudden, the old one, which is mature, people have just taken over with a new one. So that is what can be done. And cash cows can be used to finance the stars or question marks, which are in their development stages. So that is harvesting from the cash cow. Okay. So most of the time, we hold the cash cow. That's the best strategy. Hold it. But sometimes some people harvest it if it is weak so that they can use it to build other ones because it's at this salinity stage, which wants to drop to decline. Okay, so those are cash cows. For question marks, these are known as problem children. They are products with high market growth with a low market share. So do the product justify considerable capital expenditure in the hope of their increasing market share? Or will they be squeezed out of the expanding market by some rival products which will come into the market? Okay. So most of the time, what you have to do is that, are you thinking about really growing this product into a star or not? You get it? So it depends on the strategy the entity wants to maintain for this question mark. Now, question marks have the potential to become stars if they are successfully developed. That's what I was saying earlier. However, if their development is not fruitful, they may end up consuming a lot of investment and management time, but end up as problem adults rather than stars. So problem adults is a sort of product which is a problem child, but now it is sort of diving into what? Problems. Okay, you are not seeing any growth in it, but you are investing in it. So it sort of becomes like a dog in some sort, but it is not also a dog. It's dilly-dallying here and there. Low sales, everything low. Sometimes it goes up, comes down. It's not that stable for you to see. Okay, so what you need to do, I said it depends. You can decide to build it if you see that it has a future. You can decide to harvest the little you have from it or just sell it. Okay, it depends. That's why I always tell you it depends on the product. So kindly look at the question that you have been given. So for dogs, they are products with a low market share and a low market growth. They may be ex-cash cows that are falling on hard times. Okay, you know, sometimes your cash cows, when they are weak and you harvest from them, they can literally become dogs because you are not making anything from them again. So although they will show only a modest net cash flow or even a modest net cash inflow, net cash outflow modest or net cash outflow, they are cash traps that tie up funds and provide a poor return on investment. And remember, anytime you look at some of these things, you can even use return on investment to check if truly which of them is really performing well. Okay, ROI can be used. So, however, they may have a useful role either to complete a product range or to keep competitors out. There are also many smaller niche businesses in the market that are difficult to consolidate that will count as dogs, but which are quite successful. So one thing you should know is that sometimes you don't necessarily need to sell a dog. You can maintain it. Why? I usually give a typical example of a company which sells, let's say it sells toothpaste and then brush. Their toothpaste is so sour, people don't like it, but their brush is very strong. So the toothpaste is the dog, the brush is maybe a cash cow, but you can do complementary or bundling pricing or bundling sales, right? To sell them together as a bundle. Buy one brush, get free toothpaste, right? So such dogs, you hold them, you don't sell them or divest. Okay, so this is a BCG matrix, but one thing you should know is that for the BCG matrix, most of the time, a company's portfolio should be balanced. So with cash cows generating finance to support stars and question marks and with a minimum of dogs. One of the main problems with the matrix is that it is built around cash flows when in fact, innovative capacity may actually be the critical resource, particularly in industries such as electronics and cars. So instead of focusing on cash flows too much, you can also focus on innovation to sort of build products or look at how products are performing. So how does this link with the product lifecycle? So the BCG matrix can be paralleled with the product lifecycle as products develop from question marks through to stars and then cash cows, and they enter maturity and then finally becomes dogs as the product declines. Okay, so we'll revisit the BCG matrix mostly in the portfolio strategies. I'll introduce you to it again when you're looking at portfolio, but it's always the same. So there were some illustrations. So I drafted a mini case based on April 2022 strategic case study. Bazaar Stores, which is a diversified food retail business with business units. I told you when you see business units or products or divisions, start looking at portfolio, right? So they have 4 different areas. The original Bazaar Store business was a food retail business. However, and the department store division remains the largest business within the group. So we have the main business units of Bazaar are as follows. So we have a set of departmental stores, a range of fast food stores, a chain of juice bars and discount stores. So they've given us, so this one, they've given us the various strategic business units. So you see here, looking at this question, sector revenue has not been given. You remember, just like the first one. So we weren't given sector revenue, but we got the total revenue from the last financial period was 670 million split across the 4 business groups, which is like the business's total revenue over the period, right? So we have gotten this, and then we have been given the nearest rival, the nearest revenue of each rival. So we have to look at which of them is what? Which of them has high market growth, high market share, and the rest? And I taught you how to do this. So what I will do first is to try to look at, okay, which of them, and remember the formulas, which one is high, which one is low. I just discussed that earlier. So the first thing I would want to do is to calculate market share. But market growth has been given, so you don't stress. So yeah, they've given the turnover of the highest rival. So if I want departmental stores, then departmental stores will be what? 280,465. No, so remember that is your revenue over the what? The largest competitor revenue. So my revenue was 280,465. I divide this by the largest revenue for departmental stores, which was 142,235. No, so? So what do I get? That becomes my market share. So that gives us 142,235. 280,465 divided by 142,235. So this gives you 1.97, which means that this is high, not so because it's higher than 1. So because it's 1.97, we have market growth of 2, which is what? Low. You have 1.97, which is what? High. So this tells us that this product have what? Low market growth, but high market share. So low market growth, high market share. This is a cash cow. Okay, so this is how you do the calculation. So when you get any computation, now that you get, I can't do for all of them because of the sake of time. The video will be too long, but that is how you go about it. So I've given you all the different types or different kinds of style the question may come. Sometimes the question may come with net cash flows. So with this kind of question, we're supposed to write a report, okay? Supposed to write a report. So in the report, what do you have to look at? So you can talk about what it is, so dates, all that. Then your subject will be the performance analysis of the products of com using the Boston Consulting Group Matrix. If it is com, but here it was Bazaar Stores. Bazaar Store. Okay, of Bazaar Store. So introduction. So you can, I use com's solution to match Bazaar Stores. That's why you see com there, but I will change it later. Bazaar, okay. So you can look at it. You talk about the introduction, what this matrix is used for. You look at the overview, because that's what they ask. So you see, you can come up with what? A performance and classification of the products as part of your appendix. So you see, this was departmental stores was a cash cow, fast food store was what? A dog. So all of them. Then you take them one by one. It shouldn't be in a table. It's because I want to save space. Okay. So this is how you interpret it. So for instance, star products, then you underline it. So star product, you underline, then you say, for instance, the discount store. It's like ratio analysis. The discount stores is the star product of the company's product portfolio. Company's product portfolio of business units. According to the BCG, a star is a product with both a high relative market share and a growth rate. In terms of the net cash flow, star product has neutral or zero net cash flow, okay? Because stars generate equal cash inflows and cash outflows. That is why we don't consider, though they are performing well, we don't consider them cash cows, because competitors are sort of taking most of your cash flows. You need to keep investing because competitors are coming in, creating barriers of entry and the rest. So discount store is classified as star since it has what? 1.71 and 13% as market share and market growth respectively. Hence, the two dimensions of the matrix are high. You see, it's just like the normal ratio analysis. That's how you see, everything in your exam is about analysis, and I want you to get that, okay? So these figures are above the midpoint of 1 and 10% of the relative market share. So you're just telling the person that it's high because it exceeds the midpoint, okay, and the growth rate respectively. Hence, discount store is a star. Stars are products in markets with high growth rates and relative market share. High, these products are usually market leaders in the industry and their future cash flows. But if the question hasn't asked for the strategy separately, you can say that the most important strategies for managing a star is maybe to build it into a cash cow or maintain it if you feel that is the position of the company. You get the idea. Aha. So the same thing, you take cash cow, you go the same way. You take question mark, you go the same way. It's just like ratio analysis. First, talk about what it is, how it is performing. Does it exceed the midpoint of market growth or market share? Then you give your conclusion. And if possible, you may chip in the strategies, and you know the four strategies. You are either holding, you are either divesting, you're either building or harvesting. Okay, so that is it. So then you come to the strategy recommendation of the product. You see, this one was separate. That's why we didn't add it. Okay, so invest or build, hold, harvest, divest, then your conclusion. Okay. Now, there's a different kind of BCG that came that used cash flows. Okay. And this one, I will take you to May 2019 question one. It was a waste management sector question. It was a waste management sector question. Okay. So this is from my book, Applying Strategic Models. I'm doing some changes to it. So hopefully I think it will be out next date. Now, the group and company. So I always give a summary. So one of the major large companies operating in the waste sector is Waste Tiger Limited, and is part of the Omega Limited group of companies. Omega Group Limited of companies. Now, the other subsidiaries under OGL include Sewage Systems, Medical Waste Treatment, GCD Diamond, JB Plant Pool, ACB Bank and Recycling and Compost Plant. So this is what they are. So we have a brief description of subsidiaries. So you see, it is based on what I was telling you earlier, that when you see divisions, subsidiaries, strategic business units, and products, you are likely to be using portfolio models to deal with those products. Okay, so we have Waste Tiger Limited, which is involved in collection of solid domestic and commercial waste in various municipalities, metropolitan and district assemblies. You have sewage systems and medical waste treatment, which handle liquid and medical related waste across major cities. You have GCD Diamond Limited, which is a mining company involved in extraction and processing of raw diamond, which was added to the group 4 years ago. JB Plant Pool, ACB, Recycling. So all of them, you need to know what they do. Now, the group CEO, Mr. Joseph Kwenu, is not enthused as the rising cost of the group and its subsidiaries due to duplication of functional areas within each subsidiary. He wants to reconfigure the existing organizational structure in which there will be a dual line of reporting and responsibilities. The CEO wants a structure that combines functional specialism, which is market, finance, human resource, and IT, and the subsidiaries. And by so doing, eliminate subsidiary-specific functional areas. Again, the structure should result in keeping subsidiaries largely independent, but with necessary intervention with respect to functional activities. So the group wants to do so. So even they can ask you what type of organizational structure this is, and that's the matrix structure. And as part of that question, they ask the advantages and disadvantages of matrix structure. Anytime you are commenting on organizational structure, just like any strategic choice question, you just need a pros and cons. That's how we do strategy. Now, the group CEO wants to do performance analysis of the various subsidiaries based on the extent of cash generated and used by the respective subsidiaries. The group chief financial officer was tasked and has generated a summary cash inflows and cash outflows for each subsidiary. So what if, for the first time, ICA in strategic case study decides to go this way instead of bringing revenues and competitor revenues, they decide to come cash flow. Then how would you know which one? And they tell you to apply the balance scorecard. Then people will not be happy. So we can see their cash inflows, okay, the various cash inflows and cash outflows and the net cash flows. So just like you have here, you can use this to identify which one are you getting it. So note, this question uses cash flows instead of revenue. So how do you deal with this? Okay, so if you take a star, let's look at the position. Okay, so it says, well, star subsidiaries are those with high market share and high market growth. Their high market share implies that they generate lots of cash. However, their market growth suggests that they require a high level of investment to either increase market share or continue being the market leaders. So their net cash flow position will vary from neutral to marginal, positive, or negative. You get it? So it's not giddy, like, so it grows by smaller changes, but either it will be zero or it will grow by smaller changes. Are you getting it? So thus they usually exhibit low profitability and may sometimes require support by means of cross-subsidization. That's from cash cows to keep them ahead of the competition. They would eventually become cash cows if their market growth rate declines, right? So given the cash flow information with respect to Tiger Limited and JB Plant Pool, it could be inferred that both companies are stars because both companies exhibit high cash inflow of 95 and 150 respectively, as well as high cash outflow of 98 and 145 respectively, resulting in net cash flows of negative 3 million and positive 5 million respectively. Are you getting it? So you see the revenues and inflows, the inflows exceed the outflows, and you have negative cash flows, or you have what, positive cash flows, but they do not grow by what, huge margins, just smaller margins. However, this assertion is inconclusive considering that the BCG matrix does not strictly use only information about cash flows to decide what type of business. So this is very good, but in exam you cannot remember all this, so don't stress yourself. Just do what you can do to know whether the cash flow is zero, it didn't change by so much to positive, or didn't change so much to negative. Okay, so based on the information, look at the cash flow information. Notwithstanding, the portfolio strategy for this business is a build strategy. That's a long-term strategy that focuses on long-term profitability by making heavy investment in them to grow their market shares. Now, when it comes to cash cow, These are those businesses that have high market share but operate in a matured market. That is, you have low market growth rates. Not so. So their market share means that they generate lots of cash. Meanwhile, their slow growth or matured market means that their cash outflows are usually low because we are not investing in it. You get the idea? So cash outflows will be low. That they are very profitable businesses which generate high cash inflows but use low cash outflows. Are you getting it? So because the business doesn't need investment again to grow it, investment or its cash flows are low. You see, looking at it from the cash flow perspective to it makes sense. So they are very profitable businesses which generate high cash inflows but use low cash flows or require little to no investment. So these businesses have net cash flows of huge positive. That gives their corporate entities market power through cross-subsidization. So we can infer from the cash flow information of Omega Group that ACB Bank is a likely cash cow since it has a very high cash inflow of 160, but low cash outflow of 40, resulting in a high positive net cash flow of 120 million. This tells you that this company requires little investment, but has high cash inflows, right? So this tells us that this guy, he's generating a lot of cash. You see, from the finance perspective, this is how you assess the BCG. People don't usually do this type. It's usually rare, but you don't know I see. That is why you have to actually use this and know it very well. That's why I'm giving you the other side. I've given you all the different ways you can get BCG. Now, the strategic option for a cash cow is hold, right? The group should make the necessary investment to maintain the market share while using the excess cash to cross-subsidize the other businesses within the Omega Limited portfolio group. But one thing you should also know is that cross-subsidization is also harvesting. So you can take from the cash cow to support other ones, or you maintain its position. Okay. So harvesting a cash cow should be the weaker one. If you see that the cash cow is sort of becoming weak, then you take all the money to support the other ones. Now, what about question mark? So this is a business operating in a high growth rate market and possessing a low market share. Now, this business is a direct opposite of the star since it generates low cash inflows, but makes use of high cash flows. So how do you spot this one? It usually exhibits a high and negative net cash flow position. Okay. So unlike the star, which could be a small positive net cash flow or a small negative net cash flow, this one will have a high negative net cash flow because you are investing more into it. That's why we say it is at the introduction stage. We are investing more and more into it, right? But the market share to the revenue position or the cash inflows are small. So invariably, it usually exhibits a high and negative net cash flow. So looking at the data, the sewage system and medical waste transplant, medical waste treatment and recycling compost are two subsidiaries that may be described as question marks with what? Respective negative net cash flows of 40 million and 75 million. You see, unlike the star, which was negative 5 million or 5 million, you see, those ones are smaller marginal net cash flows, but these ones are huge. So the portfolio strategy is to build these ones where there are prospects in the market or harvest them when we don't see prospects, just like I taught you earlier, okay? So dog is a business with low relative market share and low market growth. So it generates significantly low cash inflows and may not require significant investment since its market is no longer attractive. So you see this one, the cash inflows and cash outflows are all very small. So you can see it has, when you look at the Omega Group, GCD Diamond has what? Cash inflows low, 10 million, cash outflows 11 million, very small. So the appropriate portfolio strategy is to divest this from the group or sell them. Or if it is something that can be used as a complementary product, maintain. But note that the cash flow information given in the data is not sufficient basis to use the BCG to do proper analysis. You may consider revenue and other things. So in order not to penalize students unnecessarily, any student who uses any other portfolio analysis matrix to answer this question should be given the benefit of the doubt. That's what the examiner said. So that's why I told you guys earlier that maybe you are asked to do like last two dates. That was it December 2022, when students were told to use the shell directional policy matrix. If you didn't know and you still use BCG to answer, you'll be given the benefit of the doubt. Okay, so you can even chip this in the life cycle model as well. I said, do anything it takes to pass. Okay, so that's about the Boston Consulting Group Matrix. In our subsequent sessions, I would be looking at the Shell Directional Policy Matrix, the GE Planning Grid, the Public Portfolio Matrix, the Ashford Portfolio Display, and other portfolio analysis models that could be considered, as well as how the life cycle model fits in strategic evaluation. That was the life cycle model by A.D. Little.